If you're interested in improving your credit score and learning how it's calculated, then this video is for you. Your credit score impacts your interest rates, your insurance costs, your ability to borrow, and potentially where you're able to live. But here's the good news. Your credit score is not fixed. It's not a reflection of who you are. It's quite simply a math equation. Now, it's a complex math equation, I'll give you that, but understanding how it works is the first step to improving it. Today, I'll break down the biggest myths around credit scores, how your score is actually calculated, and what you can do right now to start moving it up. Myth number one is that you need to carry a balance or pay interest to build credit. You don't. You don't need to carry a balance. You don't need to pay interest. Here's a pretty popular figure completely misleading you here.
Okay, I have an 800 credit score. I'm really sorry. That cost you at least $100 grand in interest. Because it means you've paid back a lot over a long period of time. You've been playing kissy face with the bank a lot.
Now, Dave either doesn't understand how this works or he's intentionally misleading you. Either way, this is simply not true. Credit scores reward how you use credit, not how much interest you pay. The best case scenario is to pay off your credit cards fully every month, not pay a dime in interest. You can pay them off even before your month end hits, which gets you a boost due to having lower credit utilization, but I'll have more on that later. Myth number two, checking your credit hurts your score. This keeps a lot of people stuck. Looking at your credit report does not hurt it. These are soft inquiries. There is no impact. What affects your credit score are hard inquiries, which usually happens when you apply for new credit. Even then, the impact is typically small and temporary. Avoiding your credit because you're afraid to look at it is usually more damaging than the inquiry itself. In fact, you can go to annualcreditreport.com and get your credit report for free with no credit impact. This might be a good starting point if you're looking to implement a credit improvement strategy or a debt payoff plan. Myth number three, closing old cards always helps your score. Sometimes it might often. Closing an old card can reduce your available credit, increase your utilization, shorten your credit history. That doesn't mean you should never close a card. It just means that you should understand the trade-offs before you do so. Now, if you're simply not a credit card person, for example, if you max out any credit card you've ever opened, you've paid gobs of interest to credit card companies, that's a different discussion. But if you're responsible with credit cards, you can pay $0 in interest, earn rewards, and improve your credit score. That is the optimal situation, but this is going to be very personalized to how you use credit. If you're simply bad at it, your ultimate goal should be to change your behavior and lower or eliminate the unnecessary interest that you're paying your credit card companies. Your credit score might be secondary to that. How credit scores are calculated. Credit scores are based on 5 main factors. Now, each credit agency has its own unique algorithm, which is what can make the credit scores seem confusing. But each agency has 5 main components that matter. Number 1, the payment history. This is the biggest part of the score. It answers the one question: do you pay your bills on time? Late payments, collections, charge-offs, those do the most damage. Consistent on-time payments over time, that's the foundation of a strong credit score. Number 2, the second biggest factor is amounts owed, credit utilization. This looks at how much of your available credit you're using. If you have a $10,000 credit card limit and you're using $8,000 of that, that signals risk, even if you've never missed a late payment. Lower utilization generally helps. High utilization can drag your score down pretty quickly. The upside is that this is one of the fastest areas that you can improve. This goes back to where I said earlier, you can pay off your credit card balance down before the end of the credit card billing cycle. The credit agencies see the monthly balance reported at the end of each billing cycle, and they calculate your utilization score from that. If you strategically keep these balances low, that'll improve your credit score. And 3, length of credit history. This measures how long you've been using credit. Older accounts help because they show stability. This is why closing your oldest cards can sometimes hurt more than people expect. And 4, credit mix. This looks at different types of credits that you have. cards, loans, mortgages, personal loans, and so on, this is a smaller factor. I have heard people say, someone actually told me when I was very young that I should get a personal loan and pay it off because it would help my credit score history. If you're trying to really get to say you have a great credit score and you're trying to get a couple points ahead and you've never had a personal loan and you pay it off right away, maybe that gives you a really small, tiny boost. But I would say that you should never take on debt just to improve your credit mix. If it improves naturally, great. If not, don't force it. If you're responsible with your credit, the longer you've utilized it, the better your score will get. And 5, new credit and inquiries. Opening a lot of accounts in a short period of time can raise red flags. Each hard inquiry has a small impact, and that impact fades pretty quickly over time, but spacing things out still helps. How to improve your credit score. Here are things that you can actually do starting today. Number 1, pay everything on time. No exceptions. Auto pay is your friend. Reminders help. Don't put money on a credit card that you can't pay off within 30 days. It's as simple as that. Number 2, you lower your utilization. This is one of the quickest wins. You can do this by paying down balances, making multiple payments during the month, or increasing your credit limit without increasing spending, or a mix of the two. If you make a higher income now than when you opened your credit card, update that income with the credit card company. They might in turn give you a higher limit. You want to make sure you maintain the same habits though. This can be dangerous if you are someone who maxes out credit cards. But if you consistently pay them off, a higher credit limit is just going to give you better math on the utilization front. And 3, be careful closing accounts. If a card has no annual fee and you're not overspending, keeping it open can help. Use it occasionally, pay it off, and keep it active, especially your oldest credit card. Be intentional about applying for credit. Every application should have a reason. Do not apply out of curiosity or because of some promotion that doesn't really fit into your overall plans or needs. Number 5, check your credit report for errors, mistakes. They happen more often than people realize. Incorrect late payments, outdated balances, or accounts that aren't yours can quietly drag down your credit score. Reviewing your report is one of the simplest, highest impact habits that you can build. Again, go to annualcreditreport.com to see where you're at and use the information that you just learned in this video to put together a plan to improve your credit score over the next year. Your credit score isn't a judgment of your character. It's not permanent. It's just math. If you focus on paying on time, keeping balances low, being patient and intentional with your credit, your score will improve over time, often faster than you expect. And as always, money is a tool, knowledge is freedom, and planning is power. Hit subscribe so you continue to build that knowledge, and I'll see you in next week's video.